Kia ora koutou and welcome to Revision 5. This revision video means that we are at the conclusion of this halfway through our revision video series. Today we're going to look at balance day adjustments 2. These are the next 6, so there are 6 total balance day adjustments. We've done the first 5, accrued expenses, accrued income, accounts receivable, accounts payable, revenue in advance and prepayments, first 6. So we've got the next 6 to do. If you've got your workbook out, 1B5, it's time to write some notes. I'd like you to head up this table and press pause so we can go through them. So do the table first. Great, so the first one we're going to look at is, see if you can remember the names really. So firstly we've got accounts receivable written off. Do you remember the name of the balance day adjustment that's called? We write of accounts receivable, they're called bad debts. Alright, so bad debts are people who owe us money who can't pay us back. So it's no use having them in accounts receivable because there's no chance of getting that money back. So it's better for us to write them off. And so we're going to now do the calculation for that. So there's a bit of a calculations involved. First thing we're going to do is we're going to divide the full amount by 1.15 to give us a bad debt figure. The full amount is going to impact on the accounts receivable, and the difference between the accounts receivable and bad debts is a GST. Bad debts will go up because it's an increase in an expense, so we're going to debit that side. Accounts receivable will go down because we won't be able to collect the money from them anymore, and the GST, that will actually go down because we said to the government we're going to collect some money for them, but in actual fact we're not, so we owe less GST for a bad debt. Hopefully that makes sense. Number 2 is adjusting for allowance for doubtful debts. So what's the name of the new expense that is created when we adjust for allowance for doubtful debts? Doubtful debts, good. And so what we've got to do is, I'll do one line at a time. So we've got to calculate an increase or decrease in the current allowance. So if that allowance goes up, it's going to be plus doubtful debts. If the allowance for doubtful debts goes down, it's going to be a minus to doubtful debts or a credit to it. It's the only time that we have a negative expense. The allowance for doubtful debts amount is going to be the accounts receivable, the adjusted one after you've taken off the bad debts, times the rate. So you might be given 5 to 7%. So you'll adjust your allowance for doubtful debts figure first on the credit side, and if it goes up it's a plus to doubtful debts on the debit side. If it goes down it's a minus to doubtful debts over here on the debit side. So plus debit minus credit. A loss of value in inventory. So this happens when you've got some old stock or some damaged stock. We've valued it at its cost price, but it's not cost price anymore because the value of the inventory has gone down. Because the value of inventory has gone down, we're going to do what we call an inventory write-down. The inventory write-down is what we do, but it's not the impact on the accounts. So what we do with that is basically the old value of the inventory minus the new value, and we're going to add it to an expense called cost of goods sold. But this bottom part perhaps makes more sense, that the value of the inventory is going down, so we're going to go minus to inventory. And inventory is on the debit side, so if we're going to minus inventory, it's going to be credited, the opposite. Then we've got our 3 depreciations. So these ones here are all the same. So you can put these in first perhaps. So when we do depreciation, it's debit depreciation on the PPE name. So that could be equipment or furniture or probably not buildings, vehicles maybe. And the credit goes to accumulated depreciation on the name of the asset. The debit one will go on the debit side of the trial balance, and the credit one will go on the credit side of the trial balance. Right, so the same journal entry for each one, same debit and credit. So the first one, if we lose the same amount each year, what type of depreciation is that called? Call it out if you know it. Okay, I'll give you a clue. SL. And that's straight line. Straight line depreciation. Same amount every year. Two ways of working that out, and it's given to you in the question. One way is to calculate it, and that's the cost price, what we purchased it for. That's the figure in the trial balance on the debit side. Then we minus a residual value. Residual is a value we think we can get for it when we've finished using it. So if it costs us 60,000 and residual value's 10,000, over its whole lifetime the value will go down by 50,000. All right, and then what we do is we divide that by a number of years. If it's 10 years, it's going to be 5,000 per year. That's a complicated way. Often in the exam you get an easier way, which is just the rate, straight line rate times the cost price. I better spell price right. That is, for example, if it's 20,000 at 10%, therefore it'll go down $2,000 a year. So pretty easy one. Don't forget that in the note to the balance sheet, you'll have to write it out. Pretty much whatever it says in the bullet point, you write out in the note. Our next depreciation rate is a loss of value. It's higher at the beginning, but then the value goes down less as the asset gets older. That's often for those sorts of things that depreciate really fast when we take it out of the off the salesperson. For example, if you buy a car, the depreciation of a car goes down faster at the beginning than it does at the end. And so the government allow us to use both straight line and this rate. Give you a clue, it's DV, diminishing value depreciation. The government allows us to use both of these type when we're doing our tax. So the calculation of that, firstly, we've got to do the cost of the asset minus the accumulated depreciation that we've written off so far times the diminishing value rate. So if it cost us 20,000 and we've already depreciated it by 10,000, the carrying amount, or this part here, is 10,000, and then we multiply that by a rate, maybe 50%, and so it'll go down 5,000 in the second year. The first year it would have gone down $10,000. So again, the journal entry is the same. The third year it'll go down 2,500. The fourth year it'll go down 1,250. So you can see that the amount we depreciate each year just decreases every year. That's why it's called diminishing value. The last one I really like, and the last one I like because it enables you to allocate the cost of the usage of the asset for every job that you're on. So this one here is called, based on usage, UOU, or units of use, depreciation. A little bit of a complicated formula. It's starts off the same as the other one. So we've got the cost price minus the residual value, what we're going to get for it at the end of our life with it. So for example, we might start with a $20,000 piece of equipment, and we're planning to sell it for $5,000 when it's done so many hours or produced so many things. Often this is quite a good one for vehicles. You can imagine the school vans. Every time that we use a school van, the number of Ks gets charged against the department at a rate of 50 cents. So they use that. So for vehicles it's quite useful too, because it's the number of our vehicles will give up at 200,000 Ks. If we've travelled 20,000 Ks in a year, then we depreciate it by 10% of the value that it's going to go down. So it's not based on a year, it's based on a usage when we give it up. Again, that one's really good because if we're charging the cost of that asset to a job, we know how much the cost is based on its usage. Good, now that you've got that in, I've got a couple of exercises for you to do. The first one will be sent to you. It's this one here. I'll just enlarge this so you can see. Maybe I can't. So firstly, we've got the trial balance over here, which you're going to start with. And for the trial balance, you'll use these figures to answer the question. And I'll just move this across. These are the questions that you have to do. Alright, so you're trying to make these unhappy face a smiley face. And all I want you to do is to type in the number amount. So for example, the first one, bad debts to be written off, 3,500. How much is the account receivable reduced by? If you typed in there 3,000, it's wrong, so the smiley face doesn't change. If you type the right answer, it will give you a smiley face. Just a hint, if you click on the hint button there and you look in the formula bar, it'll give you the formula of how do you calculate it. Alright, so I'll just show you how that works for that one. Formula bar. See, you've got the formula there. Alright, that's just a hint. What I'd like you to do is have a crack at it first though. See if you can get the right answer. If you can't get a right answer, click on the formula and see what the formula bar tells you. So that's the first part, and secondly there's a code for you to do as well. Both of the link for the Kahoot will be in the email that's sent to you. Brilliant, thanks very much. Tomorrow's class, the one after this, is adjusting the trial balance, very much like we did in lesson 4. And these are the complicated ones. If you can get this right, then I can see those merit and excellences coming your way. If you don't get it right, you get the wrong figure, and then all that hard work on classifying doesn't mean a lot. So have a go at the Excel file first, and then the Kahoot. Again, have as many goes of the Kahoot as you can. You need 9,000. Let's say you need 9,000 to pass that one. Cheers, ka kite, and I will see you for revision video 6. That's halfway through, so you're doing a really good job. Thanks for joining me, and good luck with this. Let me know if you have any issues. Ka kite, bye.